Hello everyone and welcome to Insight Reads. Today we are sharing insights from the book Big Debt Crises by Ray Dalio, or as we like to call him, Big Boss Ray. You might already be familiar with his previous book, Principles, but beyond being a best-selling author, Ray Dalio is the founder of Bridgewater Associates, the world's largest macro strategy hedge fund. Macro hedge funds are big business. Simply put, they make money by assessing the overall economic conditions of different countries. If they sense a country's economy is about to boom, they rush in to stake their claim. If they foresee a bubble about to burst, they aggressively short the market and profit from the downturn. As the head of such a fund, Ray Dalio is highly attuned to the global economic landscape, macroeconomic trends, and the impact of various policies and market factors. Therefore, if you want a deeper understanding of economic conditions, listening to Big Boss Ray is a wise choice. So, back to the book. This book answers a critical question. Why do economic crises keep recurring? Is there a common thread or pattern? While economists and policymakers often attribute each crisis to a unique cause, Dalio argues that all financial crises are fundamentally the same. They are like different problems stemming from the same core principle, the basic pattern of debt crises. As someone who earns a living by predicting economic trends, Ray Dalio and his team at Bridgewater have studied and simulated 48 major and minor economic crises over the past 100 years and distilled this pattern into a model. They even created a computer program based on this model, which accurately predicted the 2008 subprime mortgage crisis back in 2000, allowing Bridgewater to prepare in advance. When 2008 came, while competitors were falling left and right, Bridgewater managed to profit by nearly 10%. Now, let's dive into today's main content. We'll start by introducing the general model of a debt crisis, then discuss whether debt crises can be avoided and what solutions exist. Finally, we'll share methods for assessing the likelihood and severity of an impending debt crisis. First up, the general model of a debt crisis. We know that economic growth fundamentally depends on productivity improvements. For any country or the world at large, technology is always advancing because the knowledge and skills humans acquire only increase over time. Ideally, the absolute productivity of a healthy country should always be rising, and so should its macroeconomic indicators like GDP, which should show a steady upward trend. However, humans constantly seek greater and faster benefits, leading to the invention of credit and debt. These concepts are familiar but not always fully understood. Generally, credit is how much money you dare lend someone, and debt is the amount they owe you back, including interest. Essentially, providing credit to someone is giving them purchasing power on the promise that they will repay you, and this promise is the debt. As long as the credit extended generates enough returns to repay the debt, everything should be fine. From a macro perspective, because productivity is always advancing, a nation's economy is like a constantly profitable company. The more it borrows, the more it can earn, theoretically enough to repay its debts. As long as resources are allocated reasonably, the macroeconomy should keep growing. This is why investments in education are never a loss for a country, because investing in education is investing in productivity. As long as productivity steadily rises, there will eventually be prosperity. Similarly, investing in infrastructure is beneficial, as credit and debt can accelerate economic development with these tools. GDP can grow faster. In finance, debt is often referred to as leverage because it can amplify growth, much like a lever. But the problem is that leverage tends to self-reinforce. As long as people see profits, more and more will choose to incur debt, and banks will be more willing to lend, driving up asset prices. Under leverage, our economy might advance too quickly and too far. Consider housing prices in major cities; they don't rise blindly. Such rampant growth leads to excessive national debt. Once a certain tipping point is reached, banks and investors alike start to fear. They seek to minimize debt and liquidate assets to repay it. This is deleveraging. Unfortunately, deleveraging also self-reinforces. Once people doubt the value of their assets, illiquid markets emerge, banks tighten credit standards, and everyone panics. Asset prices plummet, debt pressures rise. defaults and bankruptcies surge, and the economy starts to contract, the GDP curve bends downwards, beginning to decline. This is how a minor debt crisis occurs. In the author's words, if a major debt crisis is akin to a high-speed head-on collision, a minor debt crisis is just a fender bender. So how does a major debt crisis occur? Reflecting on the previous content, we notice that the government's role hasn't been mentioned yet. According to the author, major debt crises are triggered by government intervention. No government can remain passive during economic booms or slumps. In minor debt crises, governments often lower central bank interest rates to stimulate borrowing and investment, accelerating or reviving the economy, continually alleviating minor debt crises. However, this leaves a hidden danger: total national debt does not effectively decrease, and central bank interest rates can't always be lowered. The minimum is zero. Eventually, the central bank will be powerless against high debt levels. Bad debts that can't be recovered cause asset prices to plummet, triggering chain reactions of business failures, bank bankruptcies, and a sharp GDP decline, leading to a major debt crisis. Alright, that's the general model of a debt crisis. Next, let's discuss whether debt crises can be avoided and what solutions exist. The author is quite pessimistic about avoiding debt crises. On a macro level, everyone is in a massive prisoner's dilemma. Even if everyone rationally faces temptation and fear, avoiding blind borrowing or deleveraging, they still can't know if others are equally rational. Even if I know I'm right, if others invest while I don't or others withdraw while I don't, I'll still suffer heavy losses. Therefore, no country has ever perfectly balanced borrowing too much and too little. It seems that a major debt crisis every 15 years or so is largely unavoidable. However, the author is relatively optimistic about the feasibility and effectiveness of government macroeconomic policies. He believes that from the perspective of policymakers, even if a major debt crisis occurs, it can be relatively smoothly managed with the right policies. This requires meeting two conditions. First, most debt must be denominated in the national currency rather than foreign currencies. Second, policymakers must know what to do and have enough authority and execution power. Let me explain these two conditions. First, why should debt be mainly in national currency? Because in all debt crisis cases, governments eventually choose to print money to stimulate and restore the economy. If it's national currency, it might just devalue slightly, but the printed money fills the gap. The losses can be spread over different years and groups. But if it's foreign debt, like in dollars, it causes domestic currency holders to panic, fearing devaluation, leading to a rush to convert to dollars. The exchange rate plummets, more money is printed to repay foreign debt, investors convert more dollars, and capital flight ensues. In this vicious cycle, more money is printed further, devaluing it, making foreign debt unpayable. With plummeting exchange rates, uncontrollable inflation ensues, turning a debt crisis into a currency crisis. So, national currency debt can be remedied, but foreign currency debt is a lost cause, leading to long-term recession. Examples include the currency devaluation and hyperinflation in Brazil, Argentina, and Thailand. Now, the second condition requires policymakers to know the correct course of action and have enough authority and execution power. So, what is the correct course of action? There are theoretically 4 ways to tackle a debt crisis. First, fiscal tightening, meaning the government spends less. Second, debt default or restructuring, which means not paying back or extending repayment terms. Third, lowering interest rates and printing money. The central bank cuts rates to stimulate the economy and prints money to rescue it. Fourth, more extreme, is redistributing wealth, transferring funds to where they're needed, most effective but challenging to implement. Each of these methods impacts the economy differently. The author believes that, through clever use and coordination, these 4 methods can theoretically reduce debt burdens, maintain economic growth, and keep inflation in check during a debt crisis. Why is significant authority and execution power needed? Because policymakers must balance everyone's interests, and the most efficient solutions often come at the expense of some people. Facing various regulatory and legal constraints, politicians face immense resistance. Japan's economic crisis in the 90s resulted from a series of poor decisions due to such constraints. In contrast, the US's response to the 2008 subprime crisis was relatively better, considered an elegant deleveraging by the author. They learned from Japan's mistakes, and the US's international status allowed them to take necessary actions. Finally, let's discuss how to assess the likelihood of a debt crisis. To evaluate the probability and severity of a debt crisis, we can focus on 4 indicators. The first is the debt to GDP ratio, which we can call the debt ratio. This ratio shows the overall debt level of a country. As mentioned earlier, debt isn't a problem if it generates sufficient returns to repay itself. In a healthy economic system, when debt increases, GDP should also rise accordingly. But if the debt ratio grows rapidly over a period, it indicates that much of the debt hasn't generated corresponding returns. A high debt ratio itself is a warning sign that a country's ability to bear debt is nearing a dangerous level in all countries that experienced economic crises. The debt ratio reached over 100% 5 years before the crisis. The second indicator is the national savings rate, the ratio of money saved in banks to GDP. As mentioned earlier, bank lending is crucial in every economic crisis. If the savings rate is high, banks have ample liquidity to continue lending and weather minor debt crises. But if the savings rate is low, a major debt crisis may ensue, as banks run out of money, leading to liquidity crises and a complete economic collapse. The third indicator is the interest rate gap. Simply put, it's the difference between the current central bank interest rate and the lowest possible rate. For instance, the Fed's rate ranges from 0.5 and its current rate is 2.5%, so the interest rate gap is 2.5%. If it's 0%, the country's central bank has exhausted its tools to tackle minor debt crises, increasing the risk of a major crisis. The fourth indicator is the monetary gap, which is the difference between the actual and required money supply for economic growth. It's hard to measure but can be approximated by the growth rate of the central bank's balance sheet. A normal economy should have a stable money supply, and any deviations indicate potential issues. These 4 indicators, the debt ratio, national savings rate, interest rate gap, and monetary gap, provide a comprehensive picture of a country's economic health and the risk of a debt crisis. By monitoring these, we can better anticipate and prepare for potential economic downturns. Thank you for joining Insight Reads today. We hope this summary of Big Debt Crises by Ray Dalio has provided you with valuable insights into the patterns and solutions of economic crises. Stay tuned for our next episode, where we delve into another thought-provoking book. Until then, keep reading and stay informed.